So topic for today is transfer pricing of management services. And this is a topic that has been in news for quite some time. And it has been a highly litigated topic. Previously, we had some transfer pricing editions on this issue. And transfer pricing editions are continuing to take place on this issue, which is why we thought this is an apt topic for discussion. I will yes. So before we begin with the webinar, just an overview of the aspects that we'll be covering in this webinar on management charges. To begin with, we will take a look at the concept of management services. What is the benefit test, which is applied by OECD and also by Indian Tax Department for assessing whether management charges are genuine or not. There is a concept of chargeable versus non-chargeable services. Non-chargeable services, also called shareholder services or duplicative services. Then we will look at what is the difference between management services and a cost-sharing agreements. We will not dive deep into the nature of cost-sharing agreements, but just broadly look at the difference between these two concepts, because they both entail a payout to a related party. But there are some differences which it would be helpful if we keep in mind. Then we look at what exactly is the tax department's challenge when it comes to management services. What are the grounds on which they disallow management charges? After that, we will take a look at what are the points which the taxpayers can raise in their defense, how they can prepare for warding off such a challenge. We will end the webinar by looking at the Indian safe harbor rules on low value adding intra-group services. These are in a way a kind of management services, and there is a safe harbor prescribed for such kind of services under Indian safe harbor rules. What is the safe harbor? How does it fare vis-a-vis the OECD and global best practices? Are there any shortcomings in this safe harbor? And how, if this safe harbor could be strengthened, maybe the degree of disputes would reduce. So we will look at all of these aspects, and now we just move forward to the content of the webinar. So friends, just a quick glance at how management charges and intergroup services has been making waves, ripples across the globe. It is not just in India, but as you can see, the international community has been seized as such with the transfer pricing of intra-group services. So whether it is Germany, Russia, or any other country. And very recently now, as most of you would be aware, that UAE has also introduced transfer pricing regulations. And there are a number of number of companies with regional headquarters in UAE. It becomes very apt for them to understand that if there's any regional headquarter which is providing intra-group services to its associated enterprises, then it amounts to a management service, and there is a transfer pricing science methodology that needs to be followed in charging out for those centralized services. The charge cannot be ad hoc. Charge has to be computed in a rational manner. There has to be proper documentation to support the charge. So this is not just an India-specific issue, but this is certainly an issue of relevance for multinational enterprises across the world. And the principles also that we will be discussing as we move along are relevant for not only for transfer pricing from India perspective, but whether it is transfer pricing from a UAE perspective, Germany, US, UK, or worldwide, because these are arm's length principle or transfer pricing principles based on arm's length principle, which are relevant on a worldwide basis. So just briefly, to begin with an introduction on what is the management charge. Of course, we all are aware that in a multinational enterprise setting, there are services such as HR services, IT services. It could be payroll processing services, financial advisory, budgeting, planning, resourcing, procurement. These are services which in a multinational enterprise setting may be centralized in a particular region, or at a global level also it may be centralized with one particular company in the multinational enterprise. The reason for such centralization is simple. They just want to realize economies of scale, synergy, specialization. They do not want that uh, extra amount of cost or double the effort or cost should be spent in having such service centers at all the different locations where they have operations, but rather just centralize all these services at one place and then reap the benefits of economies of scale by providing these services from that particular location. So this is the concept of management charge. So it is a charge for management services in the nature of IT services, HR, you can have corporate affairs management, commercial purchasing services, and there could be n number of examples of these kind of services depending upon the exact management, the multi-enterprise setting. So just briefly, this is the whole concept of management chart. Doesn't need much of time here, very basic. We just, after discussing this concept, move on to the concept of benefit test. Benefit test is a test that is applied by OECD, also by UN guidance, to test whether or not a service that is being received by an associated enterprise from its related party, whether that service is really a chargeable service or not. So as per the benefit test that is applied by them, there is a two-pronged test or requirement to be fulfilled. So one prong of their test is that the service must have some economic or commercial value. And the second prong of the test is that an independent enterprise should be willing to pay for such a service. The second test really is a test of an arm's length simulation, whether in third-party circumstances, an independent enterprise would be willing to pay for receiving a service of this kind. So both UN and OECD guidance are in sync as far as the benefit test is concerned. It has two elements to it: realization of economic or commercial benefit, and second is the fact that you need to be able to demonstrate that even in a third-party setting, such services would be chargeable. So if the benefit test is satisfied, then you can safely say that yes, the service that I'm getting, I can validly pay for it, and it does not amount to profit shifting or just taking funds out of a jurisdiction to merely reduce my tax base. Now, linked with the concept of benefit test is the concept of chargeable versus non-chargeable services. So we have seen that various services like HR, payroll processing, accounting, IT, troubleshooting, all of these are chargeable services. But then the parent company or a group company may also be rendering some services to its associated enterprise, which may not really be chargeable. The benefit for these services is actually accruing, but the benefit is by rendering these services is actually being realized by the service provider by the mere factum of the rendition of these services. So for example, if the parent is rendering services to the subsidiary in the form of shareholder meetings or supervisory meetings, or it is drawing up the consolidated accounts, the reason why the parent is undertaking these services for its subsidiary is for its own benefit. These are termed as shareholder services. The idea is that the parent is performing these services for its subsidiary in its capacity as a shareholder. It in any case had to do these services, and the direct benefit from these services is being received by the shareholder itself, which is the parent company. And therefore, no extra charge or no monetary charge per se is justified for this, right? So if we just go back in terms of the two-pronged test or benefit test, which we saw, so whether any economic or commercial benefit is realized, the answer is yes. The parent company is realizing an economic or commercial benefit by rendering these services. That is why it's rendering. But the second question, whether an independent entity, under similar circumstances would be willing to pay for it, well, there the answer is no, because the subsidiary which is receiving these services, would argue that fine, we are benefiting, but the parent itself is equally benefiting or benefiting more because these services, they are expected to perform in the interest of the group. So these services are therefore considered as non-chargeable services. So OECD has also recognized concept of shareholder services. In India as well, this concept is well recognized. In the Supreme Court ruling of Morgan Stanley, the court has referred to the concept of shareholder services. In the context of the Morgan Stanley ruling, when the employees of the foreign enterprise visited Indian company to render training services for upgradation of quality, it was considered as a shareholder services, since improvement in the quality of the group as a whole would benefit the parent as well. It would be for the benefit of the group overall, and therefore such a service was qualified as a shareholder service. So what we need to understand when we are dealing with intra-group services is that we need to bifurcate all intra-group services into two parts. One is the chargeable part, which is the management services for which you can actually raise an invoice, and the other part is the non-chargeable part. This line of distinction is not a very it's not a watertight distinction. It is a gray area, and one has to be careful and analyze the nature of service closely. High level decision making, involvement in strategic direction to the subsidiary or to the group companies, high level shareholder meetings, strategy meetings, supervisory meetings, drawing up consolidated accounts. All this is something which you could qualify as a shareholder service. And therefore, any time which the top management in the parent company is spending for these functions, it can be argued that that is non-chargeable. So for intra-group services, you will, like any other service, you will charge cost plus a markup. Whereas for shareholder services, no payment is required. Another distinction that we need to keep in mind is between chargeable management services and cost sharing arrangement. Cost sharing arrangement is altogether a different contract between related parties, wherein they come together to create an intangible. So it is not really a scenario where one entity is providing services to another. Okay. In a cost sharing arrangement, what happens is that all the different entities, as you can see on the right hand side of the slide before you, A, B, C, D, they are together in a joint R&D effort. So they are all pooling in their efforts to develop an intangible. And whatever contribution they are making, they are cost contributions, which will entitle them to ownership of the resulting intangible. On the other hand, in case of a vanilla intra-group service or management services, there is one center which is specializing in the rendering of those services. It is rendering services to B, C, D, and B, C, D in turn are not having any claim or ownership in any resulting intangible. For that matter, there is no intangible that is arising here. It is just a case of pure rendering of services and receiving a payment for services in return, right? So in the scenario of intra-group service, there is no question of joint ownership, joint economic ownership of the resulting intangible. So this is just another fine distinction that we need to keep in mind. So broadly, I would say that when we talk about service activity, there are three kinds of service activity happening between the different entities of a multinational enterprise. So one is the chargeable management services, one is the non-chargeable shareholder service, and third, you could say, are in the nature of cost contributions. So these are distinctions that one needs to keep in mind, because the transfer pricing treatment for each kind of service, each kind of activity is different. Because we are discussing the benefit here, we might also just look at some guidance from Indian courts on how do you go about understanding the benefit. The moot point is that if I am rendering, let's just step a few slides back, that if I am a centralized service provider and I'm rendering services such as IT services or HR services to the other entities in the group, how do I demonstrate the benefit to the tax authorities that yes, as a recipient of these services, I am getting these services from the head office and I'm benefiting from these services? Do I need to quantify the benefit? And more importantly, can the benefit really be quantifiable? Is it quantifiable? So the courts have clearly mentioned that it is not necessary that you need to make a monetary quantification of this benefit, and nor do you have to demonstrate this benefit from the service in the form of an increase in profitability. these services which we are receiving, in any case, it is not like you are buying goods or there is something tangible that is flowing. The services are simply being received in the form of some assistance for HR, IT operations, so on and so forth. So you can't demonstrate any tangible flow of services. All you can demonstrate is through circumstantial evidence that yes, these services were indeed received. And as we shall see in a subsequent slide, the best way to demonstrate that these services have been received is to give indirect evidence such as emails, wherein you have which testify that yes, you have received some IT services, troubleshooting emails, or maybe some documents on HR policy which you've got from the head office, conferences, presentations. You've got guidance from the head office on finance, budgeting, procurement. So we have to build up a volume of indirect evidence to demonstrate that yes, the head office was actively involved in providing such services to the different entities in the group. Whenever the department alleges that you have not demonstrated the benefit, it is not necessary, as the courts have also pointed out, that you need to show an increase in profitability. That ever since we started taking services from the head office, our profitability at the India level has been increasing. That's not required. All you need to do is you need to show that yes, the flow of services was happening. You need to give them a compilation of indirect evidence, and that is sufficient. Okay. Very often the tax authorities will question the wisdom in taking these centralized services from the head office. Their arguments can be that you yourself are having an accounting staff, maybe you're also having a team of IT professionals. It is evident from the split of your payroll, the salaries and wages. Then why are you taking such services from the regional head office? Is it not amounting to duplication? Then based on the facts, one needs to explain to the tax department that maybe for some kinds of services we have in-house people, but then for other services which are standardized across the group, we have a centralized team which is providing these services sitting in the regional headquarters. And it is entirely our call. It is the group's call. It is a business decision made by the company whether or not it needs these services in-house or whether it must go for a centralized center to provide these services. So the courts have acknowledged this, and they have said that whether you have an in-house team or you outsource it to a company within the group, that is entirely a business decision. And the assessing officer cannot step into the shoes of the businessman to judge what is good for the business. So these arguments by the tax department that you have not demonstrated the benefit, or that you should not have actually undertaken these services because it's not commercially does not make sense. All these arguments actually fall to the ground when we look at the jurisprudence on this issue. So benefit test in that sense is not a test that is very difficult to satisfy. If you have ample evidence to be able to demonstrate that yes, these services actually happened, then you should just submit that. It does not call for an econometric exercise or a very complex quantification so as to prove that while you received these services, your profitability also went up, or that you were making profit. To actually give you a example of another extreme. So supposing you are a loss-making company and you are still taking management services from the head office, but in India you are making losses. Then can the tax department say that because you are making losses in India and still you are taking services from head office, which is actually increasing your loss, so therefore I am disallowing the management charges because it is just a device employed by you to increase the loss? Well, this kind of logic does not work when you look at the tax jurisprudence, because again, whether I'm outsourcing my service to the head office, I'm taking services from them, that is a business decision. If I'm making a loss, that may be a result of several other factors. Maybe the market is really down, or there are adverse economic circumstances. But I have taken as a businessman a call that given the synergy, economies of scale, various benefits, I want certain services from the head office. So just because my India business is in loss, that does not mean that the management charge should be disallowed. That will still stand. All I need to do is I need to substantiate it with the circumstantial evidence of emails, presentations, and whatever evidence that I have that yes, it is not just a profit shifting device, but indeed these services were received. So we have a lot of support on this point from the courts. Now, let's just quickly look at, we have discussed about the kind of attack which the transfer pricing officer, the tax department launches. How do we actually go about defending against such a challenge against management charges if it does arise? So in terms of documentation, one thing which we need to understand is that for all management charges, the starting point is a very strong intercompany agreement. And this intercompany agreement must have reference to the nature of services that you're getting. So if you're getting different services like IT, purchase, or procurement services, HR services, all that should be mentioned in the agreement. There can be multiple recipients from the head office, so the list of those service recipients should be enumerated in the agreement. Very important part of the intercompany agreement for management charges is the computation formula, which determines how the charge for management services is to be handed out to each associated enterprise. This computation formula invariably is based upon an allocation key. So at the head office level, where IT services, procurement, all these services are being provided, the cost is centralized, and it is not possible to directly identify what cost must be attributed to which particular enterprise. Therefore, obviously, in such a scenario, we will take an allocation key, basis which the cost will be split amongst the different participants. This allocation key can be sales, it can be the number of personnel, the number of users for a particular software. So depending upon what is the nature of charge, the allocation key will also vary. It must be such an allocation key that it has the most proximate nexus with the benefit that is flowing to the recipient. We will discuss allocation key in more detail in subsequent slides. But moot point right for now is that intercompany agreement is a very important document. If a company wishes to defend its transfer pricing before the tax authorities. The management charge further, it can be, in some cases, they may choose to do a cost-to-cost charge, but most of the times the charge for management services, intra-group services, is a cost-plus charge. So what they do is that the company will first compute its centralized cost for providing these services to the different associated enterprises. Then on this cost, a markup will be loaded. This markup could be 3%, 4%, 5%, or whatever. This will be determined based on a benchmarking exercise. And once the cost plus markup is determined, then that charge will be allocated. It will be split across the different recipients of services on the basis of the allocation key. And so you need to, when you're defending a case of management charge before the transfer pricing authorities, you need to furnish the intercompany agreement. You need to explain how the management charge, which has been handed out to you from the headquarters, how it has been determined. And then you also need to furnish documentary evidence to support that, yes, all these services were actually received by you. And what could this documentary evidence be? This could be in the form of emails exchanged between you and the head office, wherein discussions or references are made to the services that are being provided from the head office. In case the head office management is spending time in discussing operational aspects with the subsidiary company, helping the subsidiary company penetrate the local market, there would be some time spent on meetings, there would be meeting logs, there would be timesheets. Then there are also travel documents to support visits by the management from the head office to the subsidiary company. These travel documents like visa, tickets, hotel accommodation, travel bills, taxi bills, all that can be shared. There will be policies at the group level, like the HR policy, IT policies, finance policies, which all have been devised for the group as a whole, which head office is sharing with the group company from time to time and also updating. So all these documents, and then you will also have some presentations, conferences where the group top management or the head office will be elaborating on the group policies or providing this kind of support. So from a tax perspective, what is important for tax heads, financial controllers, CFOs is to ensure that on a timely basis they are documenting all these evidence so that when the right time comes, they can just furnish it to the tax authority. The tax authority, they are coming from this view that uh, while we do accept management charges, these management charges should be genuine. They should not be a sham, and it should not be that under the garb of nothing really happening. It's just a debit note without any substance. You are just transferring money out of India. That is their concern. If you are able to prove all these elements as we have put out on this slide, then certainly the management charge is justified and it should be allowed. If not at lower level, then at the higher level. So we are just now in this slide taking a quick look at the different kinds of services and what could be the possible allocation key. For something like IT services, the number of IT users. So if you have, for example, software like SAP or any other software which has been developed by the group itself or licensed by the group has a record of the number of users of the software. It can be the number of users in between the different associated enterprises that are using the software. For HR, it can be the number of full-time employees. For purchase services, procurement services can be the raw material cost for each entity. So depending upon the nature of service, you can you take one allocation key or the other. What one needs to keep in mind is that the allocation key that you are taking, it should have some proximity to the benefit which is flowing from the service. So of course, for IT services, IT users, it's very rational. For HR services, the number of personnel which are there in the group company, that will certainly have a closer connection nexus with the benefit which is flowing from the HR services to each company. So in this manner, you have to make a choice of allocation. This is just a brief working of what the allocation mechanism looks like. So in this slide, we have considered only two services, IT and HR services, but there could be a whole gamut of management services. And the idea is that you compute the cost for rendering of IT and HR services. So let's say in the example before us, total group IT cost is 100. And then cost has to be allocated to India. This can be done in the ratio of the users in India of the IT services to the total users. Similarly, for HR also, this cost can be allocated, but then there we are doing it based on headcount. So, and it will be very helpful if your management charge agreement, intra-group services agreement, has includes in itself a formula like the one which we have shown below, which is nothing but it is the country value of the allocation key divided by the summation of the country values for the same allocation key multiplied with the total cost of service. Cost of service is not just the cost, but also a markup. So that will give you the country's share of allocable cost or services for the respective country. Just a simplistic, nothing too complicated about it, just a simple allocation mechanism. Now, having discussed this, we are just going to look at the safe harbor for management charge, management services in India. So in 2017, after multiple requests from the taxpayers and tax experts, and also taking a cue from OECD G20 BEPS guidance, Government of India introduced a safe harbor rule for low value added intra-group services. We will just look at what are the salient features of this safe harbor, and then have a close look at how meaningful is this, how helpful is the safe harbor really. So what are the basic features of the intra-group low value added safe harbor that we have in India? So first point is that this safe harbor is available only for support services. They should not be the core business activities of the company. They should not be the core profit earning activities. As I discussed earlier, these services should not be shareholder services or duplicate services. Again, these services should not be resulting in the creation of any unique or valuable intangibles. And it also requires that these services should not involve assumption or control of significant risk by the service provider. Idea here is basically to suggest that these services are low value adding services. And that is why this condition is there, that there should not be assumption or control of significant risk. Because if the value addition itself is low, then that means that the degree of risk is also low. There is one condition which is inbuilt in our safe harbor regulations. This is a very controversial requirement or condition, that safe harbor for low value added intragroup services in India is available only when you do not have reliable external comparable data that can be used for determining the arm's length price. Okay, so we will discuss a little more on this, but this limitation, this condition for safe harbor, it's a very limiting one, because almost for all cases of management services, whether it's accounting, payroll processing, IT, it is possible to find out some comparables from external or global databases. So revenue can always come back and challenge the application of safe harbor on the basis that there, how are you saying that you do not have reliable external comparable data, and therefore you're going for the safe harbor? So this is a condition which is really, to my mind, it is a condition which really dilutes our safe harbor that we have available in India. If these all conditions are satisfied, then the low value added intergroup services safe harbor is that you can keep any margin which is up to 5%. But very important point here to be noted is that for the Indian safe harbor, this safe harbor is available only when you are receiving services from an overseas country. This safe harbor is not available when an Indian company is rendering management services to its subsidiary or a group company overseas. So this is only, a safe harbor is only, it's a one-way street, and the markup has to be less than 5%. Value of international transaction also should be less than 10 crore. This is again something which is extremely limiting, because if the safe harbor is available only when the value of international transaction is less than rupees 10 crores, then many management service transactions get excluded from the purview of the safe harbor. Another limiting condition on the safe harbor is that the reasonableness of the allocation key for the allocation mechanism has to be certified by an accountant. This is not a precondition or requirement as per OECD or as per global best practices, but this is again something which has been spelled out in Indian safe harbor. So because you need a certification by an accountant, again, it makes it little more onerous and discourages taxpayers, may discourage taxpayers from going for this. But what is really problematic is, of course, this 10 INR limit, and what I had mentioned about non-existence of reliable external comparable data. If you can prove that reliable external comparable data is non-existent, then only you can go for the safe harbor. There are some exclusions from the safe harbor on management services, and these exclusions are research and development services, IT services, knowledge, information technology or software services, KPO, BPO. These kind of activities have been excluded from the management service safe harbor. And the reason for that is that there is a separate safe harbor which has been prescribed for these services when they are rendered from India, right? So, and also because the government does not believe that these services are low value added intra-group services. They have been, this exclusion also further limits the the width of the safe harbor on management services which is available in India. This is also a point of criticism for the management services safe harbor rules. The fact is that with these many limitations of the safe harbor for management services in India, there are hardly any takers for the safe harbor. And at least I have not come across any client or any company wishing to opt for this, because first of all, the threshold is so monetary threshold is only up to 10 CR. If you are rendering from India, you cannot apply it. Only when you're receiving management services, then you can avail it. And like I said, it's a very it will be a litigative question on proving whether you had external data or you did not have external data. The whole purpose of safe harbor is to give you certainty. If you are having such a provision, such a caveat or condition in the safe harbor itself, which is controversial, then this will tend to move taxpayers away from such a safe harbor because they are looking for certainty when they come for safe harbor. We can just contrast the OECD guidance on safe harbor with the safe harbor as it is made available in India. So like I said, the definition of OECD is broader. It's an inclusive definition. Indian safe harbor, on the other hand, the definition is an exhaustive definition. So if you will just look at the definition, the way the low value added intra-group services are defined, it starts off with the choice of the word means. It says that it means services that are performed by one or more members of a M&E on behalf of one or more other members of the same M&E and which, and then it goes on. So the fact that they're using word means implies that this is an exhaustive definition, whereas OECD has kept a broader inclusive definition, leaving room for inclusion of some other low value added intra-group services also. Then exclusions are also between OECD and India. There are also differences. So exclusions are a little tighter when it comes to India. There is no monetary cap in the OECD recommendation, whereas in case of India, as I mentioned, there's a monetary cap of 10 crore, which is rupees 100 million. For safe harbor, as per OECD, should be available in both scenarios. You are rendering services and also when you are receiving services. So in both scenarios, whether a cost plus 4 or cost plus 5, that should work as per OECD. But the Indian SHR limits the application of the safe harbor only when you are receiving services from overseas. The king pin of the criticism is the use of external comparable data, which I just mentioned. The OECD does not. OECD has recommended that it should be safe harbor should not be applied in a scenario where you have internal comparable data. So, which is to say that if within the group you have comparables available, which is referred to as internal CUP. But Indian safe harbor has chosen to exclude safe harbor when there is reliable external comparable data available. Now, external comparable data can be taken from databases, can be taken anywhere, from any source, any publicly available source. And that is a huge difference between OECD recommendation and what is the SHR in India. So the fact that India is saying that no safe harbor can be applied if you have reliable external comparable data, this is significantly diluting the Indian safe harbor. Again, OECD has not stipulated the requirement of an accountant certificate, but in India, if we need to apply this, we need the allocation key, the working, etc., to be certified by an accountant. Broadly, these are the shortcomings of the safe harbor for management services that we have available in India. So there's a scope of definition is it is exhaustive. It excludes services when they are when India is rendering, Indian companies rendering services to overseas. The monetary cap is too low. There is exclusion of services in those cases where reliable external data is available. Safe harbor cannot be applied in that circumstance. That's also problematic. And then what is onerous compliance is that you need an accountant certificate to certify it, with the result that in my experience so far, I have not seen companies opting for the safe harbor. Maybe there are some companies who are still wanting to go, who are able to satisfy all of this. But when their safe harbor comes for testing before the TPO, it may be difficult for them to argue on the point that they do not have any reliable external data available to benchmark the management services. So broadly, friends, with this, we are done with the content, and we have time of around 15-17 minutes available to take the questions from the audience. So any questions are most welcome. Oh, I'm so sorry. I just saw that one participant had mentioned. I hope the screen is it visible for everyone? Screen is visible now. If there's any aspect that anyone missed, you can please put it in the Q&A, and I'll be very happy to again repeat the insights on that aspect. So I'm just going to go over the questions now. So there's one question from Mr. Ajit Kumar, that normally in an MNC, there'll be corporate accounting team that will review accounting and reporting of subsidiary. Can this be part of cost sharing? Now, Mr. Ajit, it's an interesting question, but we may need more facts on this. If the accounting team is simply consolidating the accounts for the group and the subsidiary company, then this could be a non-chargeable or a shareholder service. But if the accounting team is doing a regular or day-to-day bookkeeping exercise for the subsidiary company, then this is very similar to an accounting operation that you may outsource. So then in that case, this will be a chargeable management service. So it depends on the facts. It depends upon the nature of accounting or the financial assistance that the parent company is performing. Mr. Ajit, I hope I answered your question. Another question from Mr. Anil Chablani. Can you please clarify exclusion of management service which you mentioned in shareholder services? And from Isha, how can we prove safe harbor applicable to us? Okay, so I will take up the point on shareholder services once again, as Mr. Anil Chablani has requested. So just moving back to the slide. Yes. So, Mr. Anil, the whole concept of management services is that there are two aspects to chargeability of management service. So one is that the receiving entity, which is getting the management service, it must have some economic or commercial benefit realized. And second is that it should be willing to pay, because it would pay for this service even in a situation where it would be taking from a third party. So what happens is that there are situations where the nature of service is such that they are being received by the recipient company, whether the subsidiary or just a group company, not so much at the request of the group company or because the subsidiary company has asked for it, but this service is flowing from the headquarters for the fact that it is beneficial for the group as a whole, and the parent company or the group cannot survive without performing these services. And some of these are, for example, shareholder meetings, supervisory meetings, consolidation of the accounts for the group as a whole. So it's like if the parent company, for example, cannot really charge a subsidiary company for the time it has spent in consolidating the accounts for the group as a whole, because that is something that they are expected to do for the overall maintenance compliance for the group as a whole. I mentioned one more example, which was that of training to upgrade the quality. So this also in Morgan Stanley's case was taken as an example of shareholder service. The argument is that when the parent company is spending time and resource in upgrading the quality of services with the subsidiary company, this also the parent is doing for its own benefit, because if you have better quality of personnel or trained personnel all across the different subsidiaries, then the brand of the group will gain from such kind of training. The systems process overall, the delivery will be better. So this is something which directly benefits the parent company or the head office, and therefore there is no requirement for a separate charge for these kind of services. So these kind of services are called shareholder services. And as the name itself suggests, shareholder services are those services which are resulting in benefit to the shareholder itself. So what happens is the shareholder is rendering the service, and immediately the shareholder is also getting a direct benefit of the service. Another example of this shareholder service would be, say, if I give loan to a subsidiary for the purpose of acquisition, and I give loan for a step down acquisition, and the acquisition is for the group benefit. It is of strategic importance for the group, because I want the group to become bigger, and this whole acquisition is taking place at the behest of the parent. The decision making is happening at the parent level. So one can actually question whether that loan which we are giving to the subsidiary for acquisition, should it also carry an interest, because with that loan the subsidiary company is ultimately acquiring a step down another company or a step down subsidiary, so that this can be done in the group interest. So you don't really find a parallel for this situation in the third party real world, and you can say that this is very unique to a related party scenario, and therefore a no charge or a nil charge is justified. If you have Mr. Chablani, I hope it's a little more clear now. Your query on management service vis-a-vis the shareholder concept. If you have some specific point on this, you can ask me again. One query from Isha is, how can we prove safe harbor is applicable to us? So Isha, as I had mentioned, that if you want to apply, so safe harbor is something that you have to opt for. You have to expressly opt for the safe harbor, and that you can only do if you are fulfilling the conditions of the safe harbor. So you have to go one by one, ticking all the boxes in the safe harbor requirements. So one, the nature of your service should be, it should not be in the nature of support service. It should not be a core business. It should not be shareholder or duplicative service. Then similarly, your international transaction value should be less than 10 crores. You should not be rendering a service, but you should be receiving a service from an overseas company, because the safe harbor that's available under Indian regulation, that's only for receipt of services. So if you have met all of these qualitative aspects, then you will also apply a allocation key to allocate the cost, and that has to be certified by an accountant. So you need to meet all of these conditions step by step, and then fill up a specific form for safe harbor application, and then you have to opt for the safe harbor benefit. So first step is to actually assess that are you meeting those conditions or not. Isha, I hope this was helpful. Okay. One question from the audience. Okay. I hope I'm audible now. So there is one question on issuing of corporate guarantee towards warranty of services by the parent to the end customer on behalf of subsidiary is chargeable or can be treated as shareholder function. Warranty services generally are chargeable services. It would not, in my view, amount as shareholder function, because here we are talking about product warranty. This is a part of your day-to-day operations. If you were not to take when you provide warranty services to a customer, you always charge for it. So if parent or your group company is providing you, such kind of facility, then they should also charge for it. Both conditions of the management services, the benefit test and the test of a third party charging for it, is fulfilled in this scenario. So this should be chargeable in my view. This is a question from Mr. Bala Subramanian. So I hope it's clear. Right. So any other questions from the audience? Okay, great. Another question from Isha is, how can we prove that a service is low value add? So, yes, that's a good point. So, let's just go back to the definition of uh, low value add intra-group services. So, the low value add services, so to fit into the low value add intra-group service, you have to fall in this exhaustive definition in the safe harbor rules. So your service should be in the nature of a support service. So it should not be the core business activity. First of all, now support services are normally services in the nature of HR, IT support services, then payroll, services of these kinds, right? Uh, troubleshooting, help desk. These are the kind of services which are generally in the nature of support services. Uh, then you have to, so these are the qualitative aspects of proving that your service is in the nature of a low value added intra-group service. The quantitative aspects are that the value of transaction should be less than 10 crores, as I mentioned. It should also not amount to any one of these exclusions which are given in the definition. That it should not be an R&D, it should not be manufacturing, it should not be software development, KPO, BPO, purchasing activity, sales and marketing, financial transactions. These kind of services expressly have been excluded from the definition of safe harbor low value added intra-group services. So it depends upon the example. Like so, if you have some HR service, yes, that will be a low value added intra-group service. One general guidance that you can refer to in the definition is that it says that it should not result in the creation of intangible, nor should it involve the use of a unique intangible. And it also talks about the degree of risk, that there should not be assumption of significant risk by the service provider. This does not happen in case of services like back office IT support, back office HR support, accounting, payroll processing. All this does not happen. So you can rest assured that if you have services typically of this kind, HR, IT, and all, they will be covered in the low value added intra-group services. But your challenge will be in the other areas. Basically, the biggest challenge will be in proving that you do not have reliable external comparable data. And that is why you're opting for safe harbor. This could be a bone of contention with the tax officer. So IT services, Isha, which are excluded are specifically software development services. So if you have IT services which are in the nature of, you have these back office IT support services. So what they are doing is you are just having some people taking care of the technical glitches on a day-to-day basis. So your email is not working, or your laptop has got shut down. Your typical IT support which happens on a day-to-day basis in any organization. If someone is coming to help you do a screen sharing, or helping you send email, fix your email ID. This is called back office IT support. So your back office IT support staff is not actually doing coding, testing. It's not developing software, which happens in the IT service. So this exclusion here that you're referring to, that is for full-fledged software development service, not for back office IT support. Isha, I hope I'm clear. I hope your doubt has been resolved. Another query from Mr. Bala Subramanian is, can the common salesperson's cost sharing be treated as low value added, or will it fit in core business? So when you say common salesperson, you mean the marketing cost. So I think the marketing costs in point number 7, there's a specific exclusion: sales, marketing, and distribution activities. They are not going to consider a marketing or a salesperson's cost, all of this as a back office, so as a support service in low value added intergroup service. One will have to look into the facts closely, but I doubt that marketing, if you have a marketing team sitting overseas which is doing this activity, and they are actually doing research, and they are doing communicating with customers, all this is marketing activity, then as per the exclusion, I feel it will not be covered in the low value added intra-group service. Okay, let's just look at. Right. So there is one more question from Mr. Anand Chablani. How can parent company provide service to subsidiary free of cost if they're bearing expense for the same? So this happens only in the case of shareholder services, not for other services. For other services, it's chargeable. For shareholder services, they can provide free of cost in a way because they are themselves getting the direct benefit. So for consolidation of accounts, a company, the idea in an arm's length scenario is that if the parent company is drawing up the consolidated accounts, it has to do that in any case. It would not charge in a third party setting. So if, let's say, you were to have a arm's length negotiation with the subsidiary company on this issue, the parent company would say that we are incurring cost of drawing up the accounts on a consolidated basis. You are expected to contribute to it. The subsidiary company would argue, but that you are supposed to do as the parent company. So, that you're doing for your own benefit. We are a part of you. We are, you are a shareholder. So you have to do that. So, I mean, this is a position which OECD has taken. And the logic for that is that these are services which are undertaken by shareholder in their capacity as a shareholder. And they are not being done with the viewpoint of, earning profit. So upgradation of quality, consolidation of accounts, high level strategy inputs. These will be examples of some services by the parent company, which will amount to shareholder services. And these are considered as non-chargeable. So to answer your question, Mr. Anand Chablani, there will be some circumstances, but very limited circumstances, when the free of cost services can be availed by the subsidiary company. Very, very limited. And that is one contention always by the tax department when it comes to management charges, that please prove that none of the services that you are getting from the parent company for which you are paying, none of these are shareholder services. So what you need to do in that case is you just need to list out the nature of services, and they will all be, if they are all pertaining to the day-to-day operations, then you can argue that, look, these are services which are very routine in nature, and easily, I could have taken them from a third party, and had I taken them from a third party, I would have paid for same. So instead of taking them from a third party, now I'm taking them from a parent company, and we are paying for same, paying them for the same. Right. Okay. So I think all questions have been answered.